Hey, hi everyone. My name's PK, and here I have Anirban Roy, who's a client of the Property Investment Accelerator, and he's got a hat trick. He got 3 properties, and Anirban in this video is very graciously volunteered to sort of make time at 6 p.m. here on a Monday evening. You finished work, and so I'm very grateful for him making time. And in this video, he'll kind of we'll discuss like a bit of his background in property investing, how he got these 3 properties in a short period of time, like maybe his biggest lessons and best tips for people who also want to build a property portfolio really quickly. And maybe we'll finish it off with like how he thinks of the macroeconomic environment, interest rates are rising, etc. Someone in the game, not just an armchair commentator from the sidelines, in the game, how he's thinking about these macroeconomic environments affecting his portfolio. So stick around, guys, hit the subscribe button. And Anirban, thank you so much again for making time.
Hi, PK. Good evening. Thank you so much for giving me this opportunity. First of all, I would like to say that I actually got all the 3 properties in 3 months time span. I couldn't believe that
Okay.
myself. So it was one property after the another, and that's how I made roller coaster ride for the past 3 months actually. So yeah, it's a so I can do a pat on my back actually to have achieved that. So, yeah, so before that it was quite a say a low stake, high and dry scenario for me, as in say always yearned to get knowledge. Knowledge was more key as an important factor for me throughout the whole process. Say I have been into, say I do consulting for federal government, and say that's my bread and butter. And say through that, say myself and my wife, say we are in a decent income group. And what what we wanted to achieve was not just say off the shelf some kind of product which can be taken off and you invest and you forget about it. I absolutely am a guy who wants to get into things, get into the skin of things, try and understand what is happening, and things like that. So I wouldn't name and shame the big groups, but I have been into the game for quite a long time actually. Say I had started this endeavor from 2016, and say tried to get into the property market, but to get the knowledge in the first instance to act upon it, but that itself was not occurring. So I was trying to start off with rent investing. That was my prime aspect of it, but couldn't make it happen. So all of these big names, big short names that you have it, so all they had in the offering was at the back bench, there's somebody sitting on selling something, either a deal or some house and land packages, which was absolutely not going down my throat. So I then thought of changing my track of thinking that way. I said that let me try and find a way out where I could say build my principal place of residence and make say do an invest. I took my principal place of residence as an investment opportunity. So I know that principal place of residence can't be termed as an investment as such, but I took that notionally as a kind of an opportunity to learn things and to build my principal place of residence and try and find out whether this could be rinsed and repeated across other locations or not. So 2017-18, I bought land and then made a house on it. And say by 2020 and 21 as such, that place has actually grown in value by 100%. And I'm not joking. So
this is in Canberra.
Yeah, this is in Canberra. Yes. So that suburb actually grew in 3 years, 100%. 100% in 3 years growth. So so after I had achieved that result, I was wishing to come back into the investment game over again. Hence, what I wished to do in 2016, 17, that urge came back again once I was into principal place of residence. And I did have a good amount of equity as well, which came out of my principal place of residence. And I wanted to start off again. Here again, I started to look actively, came up with big names. They had their either their say house and land packages. They either had say their people say trying to sell up things and things like that. Then I got to know about your show from Spotify. I learn about I hear about podcasts quite say quite frequently. And then I started to listen to your podcast very regularly, and went through all of your episodes since the start of the show. And I really resonated the fact that, say, there is someone who is genuine, who looks to be genuine, who is speaking genuine. It's resonating what I'm trying to say. Then I started to actively search about you, what you are doing, and things like that, and came to know that you have a big Facebook community and things like that. And then I thought of, yeah, this is the time. I can't be late. So I joined around end of February, start of March, and I made my first purchase. It was say mid of April, which finally settled around 1st of May, first 2nd of May actually.
Yeah. Yeah.
So yeah, so it's
Amazing.
definitely a great experience, I would say, and I don't regret the fact that actually I'm very say lucky. I would say I'm very I'm do patting on my back all the time. That say I did wait for the right thing to happen with me, and I'm glad that I did your course.
Yeah. No, thank you. I think that's a really good point. Well, first of all, I'm glad that I have a podcast. I was thinking whether I should do a podcast or not. I'm glad I did it. But it's so important for anyone who's watching or listening as well, that whether it's me or someone else, there's no rush to invest. Wait for someone you can resonate with. Maybe I don't resonate with many people. For others, I do. You know, this is like we're talking hundreds of thousands of dollars. Really wait to find someone who you can trust, that you can kind of, it's sort of a little bit more than just a business relationship. There's sort of a resonation, if that's a word, of integrity, of trust and common values. But I just want to fast forward before we rewind, because your deals are fantastic. Like the first one you mentioned in April was in Brisbane. The second one, I mean, I'm just going to read this out because it's so good. This is over in Perth in WA. Purchase price $475,000. The valuation was $520,000 upon purchase. So, that's like, $45,000 under market value by the time it's settled. And one of the reasons you were able to get that, and maybe we'll pick on this a little bit later, is it was a distress sale. When it's a distress sale, it's like a divorce, death, there's some sort of D involved, some sort of deadline or some reason they need to sell really quickly. And the best thing is that the market rent is $580 a week. So that's like 7% yield or something like that. And then the next one, your most recent one, the third property in 3 months, we were talking about this before, 8% yield, basically. Purchase price $328,000, 700. The valuation upon settlement 2 months after you sign the contract is 380. So almost like, it's not 60 but about $52,000 of instant equity, you could say, by the time you settle. And the rent is 500, so 8% yield. I mean, that was your third property, the hat trick. I just want to pick on, like, you've got these amazing properties now. They're diversified all over Australia. The first question I wanted to ask was, you know even when you emailed me, I was a little bit taken aback by the fact that the valuation is so much higher than the purchase price. What do you put that down to? Like, of course, for people who are listening, who doesn't want instant equity, in terms of how you identified that under market value property, or how you found that, there was some sort of distressed sale. And obviously, we don't want to be like, we don't want to exploit people, but at the same time, we're in business. How did you go about, creating instant equity in all these properties?
Yeah, it's a good question. So first of all, before going to the specifics of property, I'll go by your notion as in. So that's how say this is the biggest picking that I get from your course is suburb does the heavy lifting. So finding out the right suburb, the right location is key. And so when we find out the right suburb and the right location, then getting a good property which is on a good street and things like that. Obviously, there would be very much of competition with regards to that. So the key factor which has helped me in all my deals is the relationship with my property manager. That's an epitome for success, I would say. Property managers say I'm a very say open person in terms of communication. So I don't hide my cards when I'm talking with my property manager and say when I'm communicating with my property manager, it's kind of getting him in my stride. That's my first aim, I would say. Getting him or her in my stride. That's how. That's the key factor that I have taken into consideration. See, in all the three deals, actually, the first deal which I had in Brisbane, it was very hot suburb, and say I actually did get an opening done before the first home opened. And that too, I'd sneaked in through my property manager. We got the home open before the home open was done to public. Say got it, and say I would say we did a backdoor entry that way.
Yeah.
The second property as such, I didn't know it was a distressed property because that was also coming for an open home sooner rather than later. But say it was say one evening when I got to understand it from the property manager that she was free as well and that the timing was suiting as well. She went in to have a casual visit where she got to understand that it is a distressed property. So the point which I'm trying to make it as is the property managers are our eyes on ground. They are doing the due diligence for us. So getting them in our stride is of most importance, and it's of epitome in terms of importance for me. And say I would rather give stress on a property manager and rather give the property manager the extra percentage in terms of doing the due diligence and taking care of my property rather than buy a substandard property which I know wouldn't work in future.
Yeah. No, that's a great point. And once I've talked about this so many times on these platforms. Well, if you can find a really good property manager, you honestly, you don't need a buyer's agent. But first, as you mentioned, Anirban, you have to select the suburb. The property manager shouldn't and won't select the suburb for you. And when it comes to suburb selection, like, you can find deals or under market deals in poor suburbs where prices are falling and vendors are desperate to sell. But we're buying in suburbs that are growing, and you've somehow managed to get under market deals, instant equity in even hot suburbs. How would you, what is your some advice, I would say, to find these hot suburbs? Because whether it's on YouTube comments or Facebook groups, everyone wants to know, oh, I have 400,000, 500, $600,000 to spend. Where should I buy? Like, how would you respond to a question like that? Where is the right place for someone to buy? How should they go about suburb selection?
So yeah, very good question, DK. Actually, say I'm such kind of a person. I'm very meticulous in nature in terms of say when it comes to in doing anything and specifically investment. That's why you heard my story. I have waited for this many years to find a person who is resonating, to find a course which is resonating. So I invested my time and my money into a course to learn things and do it myself. So my key advice would be to find out and do the due diligence by yourself, not by going through any Facebook group, any set of comments, and getting a set of suburbs which people think notionally will grow, and then I invest 400,000, $500,000, which is my hard-earned income, into something and then speculate that it will grow in future. So due diligence is very key, and due diligence, for that we require something, not expert advice, we require data which is supporting that due diligence. So one thing which I've learned from your course is do your due diligence, back yourself up. So come up with all the calculations, go through all the calculations, come up with the suburbs which are fitting the data matrices, and through that you become your own master. Find out the suburbs and then go that extra mile, and then do the due diligence in terms of, say, within the suburbs, what are the intra suburb aspects in terms of where should you buy within the suburb, and doing the final set of intricacies in terms of due diligence as well, and getting in touch with the property managers. That's even a cherry on the cake, as in, say, that way you evade the buyer's agents completely, so they are your eyes on ground. But, say, having said that, key factor is, for the due diligence, is not Facebook comments, it's not YouTube comments, it is specifically data which on which you curate, you find out, you become your own master. That's how I feel. Because that's hard-earned money. It shouldn't go to for anyone's inference. It's not inferential.
Yeah, where you invest shouldn't be a hypothesis, or it shouldn't be an
Absolutely.
inference or an extrapolation of various other people's opinion. It should be with laser precision. I'll play the devil's advocate for 1 second, Anuban. When you're talking about data matrices, and then you're going on to say, once you've selected the suburb, using that data, you use intra-suburb factors to identify the right streets. When someone's watching or listening this, it might be giving them a little bit of like a heart attack, like, oh my God, this sounds like a lot of work. Anirban's coming across like a very intelligent person. Maybe I'm not so switched on. Maybe I can't do it. Like, if you don't mind, and please be honest here, um people think that they want this stuff, they want to learn, they genuinely are hungry, but then one side of their brain says, even if I get the knowledge, I don't have confidence in implementing it. I don't think that I'll actually be able to do it, despite Anirban, buying positive cash flow, high growth properties under market value, making literally hundreds of thousands of dollars in just 3 months. Like, I'm not even making that up. People, quite rightly, I can empathize with them. They think that I can't do this and I need to outsource that to someone who will just do it for me. Um, so my question, I suppose, is like, do you need to outsource it? Or maybe a deeper question is like, how difficult is this? Can the average person do it?
Yeah, very good question, BK. So I have been asking this question over and over again. So when I so absolutely, I'm a very time poor person. Both myself and my wife are time poor person, and on top of it, we have a little one who always demands for time. So if I can do it, any person can do it. I literally do mean that. And, say, the course is such structured in such a simple way, it doesn't require rocket science. It's very easy to comprehend. And, say, once you connect the dots, and, say, once you have done that work, just once pen on paper, it's just rinse and repeat. The next time you don't require that much amount of time, and even in the first instance, it is just understanding the mechanics, and that's about it. So the key factor which worked for me in terms of, say, why I did it myself, why I didn't go to the buyer's agency, is I would rather spend 15 minutes to half an hour throughout a week's time, or even an hour for a week's time. I can devote that time to learn something and do myself, rather than mm, uh, depending on someone who is a buyer's agent, even though that can be a reputed buyer's agent who is taking the decisions on my behalf. If tomorrow I have to curse, I can curse myself. I know that the decision which I took was based on my due diligence, not anyone else's. So that was the key thing which constantly pushed me to do things by myself. So
Sure.
and that's why I waited for this long. I could have easily gone to a buyer's agent and started to grow my portfolio, but I wanted to do that myself. I wanted to make my hands dirty. That's the key thing I would say. And say in terms of time manner, if say I'm the most time poor person, I really am. I really say if I can do it, anybody can do it.
Yeah. No, no, great answer. I often get people, once again, I can empathize with people who say, look, for the first property, I want to use a buyer's agent. And then when I have a little bit more confidence, then I'll do the course. And I would, of course, I'm biased in this response, but I would say that, why not do the course, whether it's my course or any course, why not get knowledge before you invest your hard-earned money? Otherwise, you're just relying on an expert. They may be an expert, they may not be an expert. A newbie property investor, there's actually no way for you to tell who you can trust or you can't, just very quickly based on a few results. The buyer's agent isn't signing the contract. It's you who is signing the contract. So you need to know enough to be able to have the responsibility with you, not someone else. And that's exactly what you've said, Anirban, very eloquently. And maybe the last couple of things, I just want to touch on this confidence thing a little bit more. Like, what you've done incredibly well, whether it's in your principal place of residence, before you did the course, and then these 3 properties. What are your plans going forward? I mean, you've clearly got the property bug, as a lot of us do. Are you confident to rinse and repeat and do this again? And what are your plans for the next 5, 10, 15 years?
Yeah, so good question, BK. So I have got the pedal on the gas, so I'm not going to stop now. So I'm going to do rinse and repeat. I've got quite a good amount of serviceability left, so I'm going to rinse and repeat. But having said that, once I've reached that sustainability stage, I'd like to sustain that and say let it grow on its own. In terms of say, my key factor is two things, say capital growth as well as cash flow, which I definitely I'm confident I can achieve through the learnings that I've got from this course. And that's and say after 3 properties, it seems to me a cakewalk. That finding out a place of residence which has a capital growth as well as a cash flow. These are not mutually exclusive. I repeat, these are not mutually exclusive. So finding out this and say finding out properties which goes on and on and on in terms of capital growth and cash flow is easy to find. And say once you have found out that sweet spot in terms of say continuing to have these properties, say banks would also try and look at your overall portfolio in a positive aspect, because say those properties are not negatively geared. And say banks would obviously be interested to put in more in terms of say capital, in terms of serviceability. So
Yeah,
that's a key lesson I have learned,
yeah.
and like to continue with that.
And that's a good point. You mentioned, for anyone who's watching as well, Anuban, you mentioned before that you're actually on relatively healthy incomes, yet you're still buying positive cash flow property. It's very tempting to buy negatively geared property if you're on a high income because you get the tax back. But even if you can afford it, the banks, like you said, the banks penalize you. And so whereas you now can carry on buying more property, if you had bought 3 negatively geared property, let's say Western Melbourne, Western Sydney, or somewhere like that, the banks just simply won't let you buy more property. That's just a very critical thing. And the other thing that I'll just pick up on is portfolio strategy is so important. How many properties should we buy? At what point do we sell any, if any, to retire debt, increase the passive income, retire? The portfolio strategy we were discussing before off air it's a mathematical process, and you need to understand it. That's not something that a buyer's agent, well, it's not as simple as 10 properties in 10 years. It's there's more to it. And the last question I'll ask you, because it's probably on everyone's mind, you know, um, the US Federal Reserve is, I don't know when they're going to stop increasing interest rates. Inflation seems to be out of hand, both in Europe and the US. Things are more contained in Australia, but still the RBA is probably going to lift rates again, maybe a couple of times, 25 basis points. The world situation, the economic scenario is far from, I would say, filling us with confidence over the next year or two. You're not a armchair philosopher. You're a property investor. You have over $1 million of debt. You have more than $1 million of, well over $1 million, $2-3 million, I would say, of portfolio value. You have skin in the game. How do you think about, these macroeconomic occurrences? And, does it keep you up at night? Does it mean that you should stop buying? How do you think about it?
Yeah, good question. Good question, PK. Actually, say with the current facts, with the current scenario, what is going on in the market, it's kind of, so I see that as a cycle. Uh, so as within the property cycle, there are many aspects in terms of macroeconomic factors. So this is one part which is going across it. So many would try and take advantage of it, as in say from what famous Warren Buffett saying is say greedy when everybody else is fearful, and fearful when everybody else is greedy. So I take that from that aspect as well. So might be this is the time to be greedy when everybody else is fearful, and to be fearful when everybody else was greedy, when there was a boom. So, but say, long story short, Australia as a from macroeconomic perspective, as Australia has got a very strong base, and say from the lending perspective in terms of real estate, it has got a solid base. It's in terms of say where even though say there are speculators and negative Nellies who keep on speculating that the property market is going to crash, the property market is sounding is kind of bedded in a strong foothold, I would say. And say that's for that foothold comes from all the financial institutions, and they do proper due diligence when they are lending money to the buyers and the investors and things like that. So it is here to stay. It is not going away. Even say notionally, this is coming from the back of my mind is say property in Australia, the property market, the whole of the residential market is probably $9 trillion, and say out of which is only $2 trillion in debt. So which essentially says that $7 trillion is debt free. So any Tom, Dick, and Harry can easily understand that this can't crash because now $70 trillion is not debt. So
Yeah. No, well
so
said.
yeah,
No, I think that's well said. $9.7 trillion of residential value, wealth, and so LVR is very low on a, the media can say things, and you can always find statistics that paint a doom and gloom picture. But I think you're the same as well, right? In your profession, it's not about taking one or two data points. It's about telling data stories, multi-dimensional data stories, and those who really understand what's going on, they're not scared. Of course, you're not going to make 100% capital growth in 3 years like you did in your Canberra place. That's probably not going to happen over the next 3 years. But over the next 8 years, next 10 years, you'll probably regret not investing right now. But I think I just want to pat you on the back. You're patting yourself on the back. I'll pat you on the back, Anirban, for yeah, well, first of all, for trusting me. I really am grateful, very appreciative of that. And then just going hard, but in a measured way. It's not like you were just dipping your toe in the water even after you did the course. You put your foot on the gas, put down the throttle, and you got amazing results. So I think that's really what's required if people are serious about exiting their 9 to 5. So I just want to say congratulations lastly again.
thank you, PK. It has been an absolute pleasure, and I'm glad that I did your course.
Thank you so much. And for everyone who's watching or or listening. I hope that was that got you some value. Of course, these videos are, I have, a self-interest in putting out these types of videos, but Anirban and so many of my clients, they're dropping knowledge bomb after knowledge bomb, value bomb after value bomb. There was so many in there. Go back and watch it again. Just by doing what he said now, even if you don't do the course, you'll be so far ahead than other people. There's more than 80 other client interviews in the YouTube playlist. Go check it out. I don't really care if you do the course or not, but I just want everyone to, even if you don't invest, at least be educated to make a decision. Because probably if you are educated to make a decision, you'll decide to invest. And if you're really, up leveling your knowledge, you'll decide that I don't want to outsource this. I want to take the bull by the horn. I want to take responsibility of my own future. I recognize that the most valuable real estate is the 6 inches between my two ears. That seems to be what Anuban has done. So thank you for watching. Hit the subscribe button, give it a like, turn the notification bell on. And once again, Anuban, thank you so much.
Thanks, PK.